I'm now full money manager in the studio in Johannesburg is Evan Walker from 361 Asset Management. We're going to be talking about the 361 Met Equity Fund, and yeah, I'm looking at the what I quite like about this fund, Evan, is that its major holding is Naspers. We'll get into that later on, but tell us the aim of the fund and the history of the fund first.
Hi, good evening, Lindsay. The fund is just on 2.5 years, just going on 3 years in June. We launched the fund with myself coming aboard from Momentum, as I said, just over 2.5 years ago. The aim of the fund in the general equity category is to provide an alternative asset class for people that don't necessarily want to go into the big multi-managers in Cape Town, but are still looking for a broad-based sector of the market, offering exposure to small, mid and larger shares, and then both on the international and domestic side, giving exposure to the shares, where we find opportunities across the board as well.
The fact sheet I've got says you've got 76.17% SA equity and only 12.41% foreign equity. Are you allowed to get up to 25% in foreign equity?
Yes, we are, Lindsay. So the idea of the fund is to only look for foreign equity when we think opportunity sets in certain sectors of the SA market have been exhausted, or we think there's opportunity abroad in certain sectors of the market which we think have underperformed, or where there's a relative opportunity set. So we don't necessarily go abroad for the full extent of the 25%. We only go abroad to the extent that we need opportunity to fulfill the risk allocations of the fund and to offer something slightly deviant from our local Aussie on the SA market.
It's quite refreshing to speak about a fund that hasn't got everything overseas and firstly isn't one of those funds that says, well, we like Naspers, it's a great company and it's a great business, but it's just too overvalued. You don't seem to follow that because you've got 11% in Naspers. Tell us more.
Lindsay, it's exactly that. I mean, it's a unique business. Around the world, I think most managers spend their time looking for unique businesses. That's exactly why we go offshore, is to find unique businesses with pricing power. I mean, I think that's the two biggest words in investment today, are pricing power and some uniqueness in the opportunity set. So for us, Naspers was a business which was completely unique in its sector in China. There was very little competition in that space. If competition did come in, it was buying the competitor set. The valuation of Tencent obviously always looked expensive, but the growth rates were affordable to that pricing of that asset. And for us, it was just a pure, untouched environment for Naspers with Tencent in the China environment, where there was very little competition in that space. And there's few businesses that you find today which aren't finding a competition across the board and competitors coming into the environment very fast and with meaningful pricing and devaluation of their pricing regimes in their current business models.
Yeah, all the action at the moment is in the Far East. I mean, looking at this morning when I did a radio bulletin, I saw that the Nikkei Dow very close to 20,000, fresh 15-year high, and Hang Seng in Hong Kong at a 7-year high. At what point do you say to yourself, with a share like Naspers, and I'm talking not specifically about Naspers, but your theory now, at what point does it become too expensive, even for you? At what point do you start to say, 11%, let's take it down to 8%?
Well, we've been at 8 before, Lindsay, and we've got it wrong. So we're happy to take it down. And in fact, today we were actually trimming 1% off that. For us, it's all about the risk. I mean, there's always inherent risks in every equity. I mean, there's an inherent risk in owning Naspers from a legislative point of view, from a tax point of view. Anything can possibly happen. So a day like today, when it's very strong, we'll take off 1%. There's nothing to say that we won't cut that exposure. We obviously still watch the underlying rump of the business, which is still offering value in Naspers. So although Tencent is expensive or looking relatively expensive after the run which it just had, the balance of the Naspers business still looks exceptionally cheap to us. So we don't want to sell too soon. We think there's still a lot of value unlocked coming on the balance of the Naspers business, but we have to be very cognizant of Tencent. But all the time we are trimming, we are taking risk off the table if we think it's too expensive relative to the current earnings expectations. And we think it's possibly run a little bit ahead itself now with what we've seen overnight in China.
Yeah, indeed. I mean, I think it was something like 8%, close to 8% in the last 2 days for Chinese stocks on the Hang Seng. Steinhoff is another interesting story, a South African company that's going to have an overseas listing soon, very similar to Naspers in many ways because of the overseas exposure. Steinhoff, 6.33%. This is a great story. And people are talking about this as being the sort of 10-bagger over the next few years.
Well, let's hope so, Lindsay. I mean, we've owned the stock. I mean, We waited a little bit longer than a few other managers in the market. We waited until there was a little bit of a turn in the Eurozone, because we bought the stock about 2 years ago when we started to see some glimmers of hope in the Eurozone, and we know they'd done a lot of acquisitions, and the balance sheet in Steinhoff was quite stretched. For us going into this Pepkor transaction now, it's been the perfect world for Steinhoff, where we've been, for us it's about owning two great assets now. I mean, we really don't own a lot of other South African retailers. We've got Pep, with obviously the Ackermans brand and a number of other brands in the South African environment, and growing very fast offshore in Poland, etc. with Pep. And then we've got the Steinhoff brand with predominantly furniture, as you know, growing globally. So for us, it's just the perfect world, and the valuation still made sense. It's getting a little bit expensive now, again, on the Steinhoff side. Running up to this listing, it's been a little bit frothy to us. I mean, it's probably going to produce just north of R4.20, R4.30 with its earnings for 2016. So it's no longer cheap anymore. We think there's still a little bit of appetite to come in the listing on Steinhoff, so we're still holding around. But again, we're cutting exposure on big bullish days in Steinhoff as well, and reducing the risk criteria on Steinhoff.
Yeah, SAP Miller is another one that interests me. About 4.5% is your holding in that one. And there's been all sorts of talk since Mr. Buffett and the chaps in Brazil, the Brazilian private equity firm, did the Heinz Kraft merger, that maybe SAP Miller is on their radar. Are you in with this one because it's just a great company, which of course it is, or is there a potential for corporate activity?
So, Lindsay, we've actually owned that stock since we started the fund. We owned it in size. I mean, we had close to a 7 or 8% position in SAB, which did exceptionally well through the duration of the fund for us. We've taken some profit on those big frothy days where the stock was up to 675, 680 on takeout speculation. We think you're getting average growth in SAB. You're still getting emerging market exposure over the next 5 years, and that's really what we're looking for. So we're still trying to stay with growth exposure, but rand hedge growth exposure. So we try to fit the complement into the portfolio. That's why we have Naspers, BTI, SAB, is because you're still getting some positive growth coming out of emerging markets in these dual listed stocks, coming through obviously slightly better demographics, which we're seeing in South America and Africa, etc., which is still giving positive volume. And you're still seeing a dividend underpin. If you're sitting in the UK, etc., you're still getting 1.5% to 2%, which, in the short term, most of those countries are producing negative yields on their bonds. So, for us, it's about still getting positive growth, still having some defensiveness in the portfolio, and then still having the potential upside of an AB takeout if it does come aboard. But we're not really sitting there for that. We're just sitting there because it is defensive, it's still growing, and we still like the emerging market exposure that these stocks offer.
You've really got some noisy stocks in your portfolio in the top 10, which I like, and that's why I like your fund. I mean, you've got Sasol, for example. Please tell me that the 3.5% you got in Sasol was bought recently and wasn't bought 2 years ago.
Lindsay, we were quite fortunate on Sasol. We watched the oil price dipping below 100. We had an 8% position in Sasol. I think in October last year, we sold it to zero. So, the fortunate part about being in a 361, 2 billion rand fund is that you can sell your Sasols in a day or 2 days or 3 hours if you wish to. So we're not locked into these long term. We watched the oil price coming off below our criteria where we would have held it, and the valuation was unappealing, north of 550 rand, and we sold all our Sasols out of the fund. Below 400 rand on a 3-year view, we think you have to have Sasol for your clients. We just think that, natural field decline globally at around 6 to 8% will start to kick in. We don't think it'll kick in for the next 12 months, but we don't want to second guess the price on Sasol. Below 400 rand, closer to 375, we accumulate a little bit of Sasol. We're not rushing to get back to 8%, but on big down days, we will take another 0.5% of Sasol for our clients.
Yeah, finally, MTN, which is another noisy one because of Nigeria and because of Iran. And I noticed this morning when I woke up that there's suddenly the Iranians are saying the deal is on if you lift all sanctions, which throws the whole thing a little bit out of kilter. And it's 10% of their business, 10 to 15% of their business. So MTN, you're a bottom-up fund rather than a top-down, but you must look at these things.
No, we do. Obviously, we look at them. And again, it was an oil play on Nigeria being, 45% of EBITDA coming out of Nigeria. So for us, again, it was a question of we'd sold all our MTNs again to zero in the 240s, 250s late last year. And it was a stock where there was still over a 3-year period, some growth projection with a substantial dividend underpin and a very strong balance sheet. So for us, it was a question of, around the 200 mark, 205 mark, we started accumulating a little bit of MTN for our clients. It's not a stock that we're going to be rushing to buy in size. We still think there's a lot of issues going. In fact, today we've actually been lightening our MTNs, in the 223s, 224 levels. I think that's quite a rush up to that level already. We're taking a little bit of profit on MTN, and if it does come back again, we will look to accumulate back in the lower levels. So for us, it was just too cheap at 200. At 225, we think it's average for now. We certainly wouldn't be buying it, in the short term.
You sound quite active. I mean, you're in and out. You're not in things for 5 to 6 years. If you don't want to be in it, you get out, or if you do want to be in it, you get in. That's the impression I'm getting. Is that right? You sound a little bit more active than some other fund managers.
No, that's exactly it. I mean, for us, it's all about being small, being flexible, making sure that we understand the valuations at specific price points for the underlying counters. We always believe that even good stocks misprice themselves. So we always say to ourselves, there will be the opportunity to buy other good companies again. We're not the likes of the big institutions in Cape Town, which have to take more of 5 to 8 year view. Now, we like to take a 3-year view when we look at every company. So on the actual prognosis, we don't know where the valuation is going to go the following day. So on a pure basis, it must fulfill our 3-year criteria before we'll start buying it. But if it reaches the 18-month or 2-year criteria within purchasing within a month or two, we're not unhappy to say, listen, we're going to sell it to reduce the risk exposure in that underlying counter. And we're happy to do that quite fast and look for alternatives in the market. So there's certain points where the general equity fund will have 15, 20% cash in the fund, and there's other points where it'll have zero, where they think there's opportunity again. But we really do like partaking quite aggressively in what we define as good quality business models and business models that we think are still going to be enduring. So we seldom partake in resource companies, even if they've had big falls. We're very circumspect to that. We're far better at buying bigger stakes in better quality business models, and we've done so, and we've held big stakes in the likes of Netcare for the last 3 years, in Mondi for the last 3 years, which we've hardly trimmed, and we still like the prognosis. But if the valuation relative to the current environment is a little bit stretched, we will take profits.
Just a quick one. What are you looking at the moment without giving away too many secrets? 30 seconds.
Tough. The markets, our fund this year alone, including Naspers today, is up nearly 13%. So for us, it's going back into some of the small caps. We've done quite well owning some Supakus, some Afrimats, and some of the smaller companies in the SA environment. We're taking a little bit more currency offshore at 1180, just below that. We're moving a little bit more currency, not dramatic, but we might move 1% or 2% into dollars. We just think over the next 3 years, best to have a slightly more aggressive dollar position in the funds, which we're currently doing. We're looking for offshore opportunities, for that cash, which we've deployed very, very successfully over the last 3 years in a lot of the companies that we have owned offshore. So it's a mishmash, Lindsay. I won't say directly in this market, I won't say it's one specific thing. All I can say is we're not looking to buy any resource counters in the portfolio yet. We've done a slight dabble into Anglo Platinum and Royal Bafokeng Platinum at these levels. We think they're a little bit oversold, but again, those are highly volatile shares and very difficult to value. So we're very cautious at this point in the cycle. We're very cautious on risk, and we're very cautious on taking profit when we think shares have run too hard. And we're managing the portfolio very cautiously at this point, given the great returns that the market's seen and especially our fund has seen.
Evan, thanks so much for your time this evening. It's Evan Walker from 361 Asset Management.